Welcome, everyone. I'm Mark Trice, founder and lead advisor at ClearVista Financial. I'm joined here today by Jesse Hamilton here in the studio with us.
Good morning, everybody.
Sorry, we're having a little trouble with our camera today. We haven't changed if you joined us for the December broadcast, except that I might have gained a few pounds throughout the Christmas holidays and stuff. So glad you've taken a moment to join us. 2023 is underway. And we're going to give you the highlights of 2022, talk about some of the things that that are going to be happening in the next several weeks and so forth, things you'll have to pay attention to. And that's with the Secure Act 2.0 that got passed right before Christmas. And then we'll give some time for questions and things. So Jesse, I'm going to hand it off to you, and you can go ahead and start going through the year-end performances for stuff.
Great. So we're going to start off looking at our major indexes that we always talk about on these webinars. The first one's the S&P 500 large cap. We're going to look at the NASDAQ. We're going to talk about small caps, and then we're going to also cover long-term treasury bonds. So these are the standard four that we usually cover. But starting off, you can see that it was a very volatile year in 2022. Here's the S&P 500, and that index was down 19.44%.
And that wasn't even the down trend from the high, which was January 4th.
Correct.
So that was probably well over 20% from that high on January the 4th.
Yeah. So you can see this chart here. Each what we call a candle is a day, and in January you can see a 12% decline, then an 8% rally. In February, a 10% decline, small rally. And then in March, you can see that it actually went up 12%. Versus April, we lost 17%, and then back up 9%. You can see here, Mark, that there's a lot of movement up and down.
Well, I think that the main thing that the market's telling us is that trend line, which has been down, and we cannot seem to break above that trend line. We tried in December. Early December, right before the Fed chairman gave his speech, and it did not hold, and we've declined down even further. I believe we are, as the time we're doing this session, we are negative still for the year.
Correct.
When it comes to the S&P 500.
So I thought I'd cover a few points here on the timeline, Mark. The first one is right here on June 16th. There's a circle around it right there. You remember what happened there?
June 16th, well, that was our buddy Jerome Powell, the Federal Reserve Chairman, gave a talk and said that they were going to raise interest rates, but the investors heard that they were going to do this one time and then start cutting very soon, which is not what he said at all.
Right. And then we see this big rally. That was the June rally of 18%, pushing 20%. And then our next circle right here is another Jerome Powell day, right?
Right. Basically, that was then the investors interpreted they were going to start cutting interest rates anytime soon in 2023, and then in December, I guess. Actually, we're talking about June or August.
Yeah, this one's August.
Yeah,
he said we're pretty serious about this.
Yeah, that's when I got ahead of myself. That's when Jerome Powell said, guys, we're very, very serious about fighting inflation, and we're going to use our interest rate tools and as our weapons to try to cool down inflation. And of course, the market did not like that and trailed down to its lowest point in mid-October. And that's a time when they in fact did cut rates again, but somehow hinted that maybe they would be getting to a point where they were going to pause interest rate hikes, only to have that rally fall short and not break out again above that downward trend line in December. So
right, you can see there in November we briefly during the middle of the day went above the trend line, and then it fell back down and never closed above it, and then it happened again in December.
Yep. Okay.
Yeah, so now we'll check out the NASDAQ, which is the technology index, and it tends to be a little bit more volatile both directions, and it was down 33.1% year to date. And here's that same trend line we were talking about.
And that was, and the NASDAQ really started declining in late November of 2021. So this is just year to date since the beginning of 2022 through the end of 2022. But actually, the NASDAQ peaked really at the end of November in 2021.
Yeah,
and that's down by, since its peak in 21, it's down 37.7%.
Yeah, if you take that November peak to the October of 22 trough, over 37% mark.
Yeah.
So now we'll talk about the Russell 2000 index, which is small caps.
Right.
You may or may not hold some of these in your portfolio, whether you know it or not. These are still publicly traded, relatively large companies, but small compared to the giant ones, right?
And our listeners should know that small caps, when we see small caps growing in a strong way, that's usually an indication of a healthy market, a healthy economy. And so small caps were down how much in 2022?
21.62%. And here's that trend line.
But that's not the real story though, because this also peaked in November of 21. And since that peak of November of 21, that small cap index, the Russell 2000, is down 33%, 33.5% since that peak. So it's been a long downward trend, but you see the blue trend line there. That is the trend the market is going. We have not changed that trend so far in 2023.
So we've been talking all of last year about the bond market and how it's behaving. Here's a
not
chart,
normal.
Not normal at all. No, here's a chart of a long-term treasury bond index. And it actually closed minus 32.87%.
Wow, that's a big decline for bonds. They're supposed to be a safe haven for investors when the stock market's gone down. That's what we've been taught, is that bonds are your safe place to potentially go for an investor. Now that case was not true in 2022. In fact, we saw, go ahead and draw that downward trend line, because we've seen that the peak was for long-term treasuries was in December of 2021. Okay, and since then that's gone down 40.7%.
Yeah, over 40.
Over 40%, which is unheard of. And there's only been, and I've shared this before on previous monthly updates, but there's only been 8 times in the last 100 or so years that stocks and bonds have been down at the same time, negative at the same time. Because usually bonds are a place that are at least stabilized, and when there's a lot of volatility in the stock market, investors used to be able to find safety there, but not anymore. Only 8 times has that both been negative, but there's only been 2 times that the bond index and the stock market indexes have been down by more than double digits. One was in 2022, the other was in 1931 during the Great Depression. Right. Now, that's not to say that we're going to have a depression or anything like that. I do think that a recession is on the horizon, but it's not going to be to the extent that we saw in the 1930s. Okay.
Also, we forgot to mention, for people joining today, if you want to put a question in that tab on your screen, we'd be happy to answer it at the end of the program.
In the questions box. Yeah, in the questions box, we'd be happy to answer those questions. What's up next?
We've been talking about year-to-date figures. I thought it would be interesting to cover the S&P 500 over the past decade.
Yeah, sure. Let's take a look at that.
We had that 1-year chart. This is a 10-year chart. And so you can see that last portion right there is the 2022 that we covered earlier. But here is the general trend of the large cap market over the past 10 years.
So we're looking at this from the standpoint of
2013-ish.
Okay, all right. So, everybody assumes that the stock market goes up, and that's the only way it goes.
Right.
But this last year has been a wake-up call for folks to remind us that, in fact, the stock market can go down. It can go down quite a bit.
So a couple different highlights. This right here is 2018, which was kind of a choppy year. Right, not quite a bear market.
Not quite, because on Christmas Eve, as a matter of fact, the market went down more than 20% year to date off the high during the day, but closed up below 20% on Christmas Eve, and therefore it technically was not a bear market.
Right.
and then took off from there. We actually did quite well in the following year.
It did very well in 19, but then our friend COVID hit, and
Yeah,
we had
COVID
an artificial, somewhat artificial bear market, right?
Yep,
That's
absolutely.
right here.
That was mainly induced by a shock created by the government, but you can see it quickly recovered off of that.
Right. So we can see after 2020, 2021 was a very bull market year.
Yeah.
And then I'll put a box right here around this year. So that's what we just looked at. And you can see the volatility compared to the past couple
And that's
years.
really the first significant, this was 2022 is the worst year for the S&P since 2008 and 9.
Right.
So, okay.
So we'll take a slight turn here and talk about some more macroeconomic things and look at a few indexes for moderate growth, that type of thing. But first, let's talk about the yield curve. So we've been talking towards the end of the year about how inverted the yield curve is, right?
Mm-hmm, yeah.
And so this right here is a picture of 12/30 of basically the end of last year, the last trading day. And as you can see, the short-term yields are inverted compared to the long-term yields, right?
Yeah. And that's not normal. Normally we see the curve look kind of the opposite of this, where the on the shorter term yield, shorter term duration bonds, we see the curve be kind of inverted, where the short term stuff is at the bottom of the page and the longer term stuff is at the higher. But what we're seeing right now is that the short term type T-bills and treasuries are paying a higher interest rate than the longer term, and that's indicative of a recession.
Right. That's every time in the past that's been the case. You know, if this doesn't foretell a recession, it'll be the first time in a century. That's not to say that it can't happen, but it has never happened before.
Yeah. Okay.
So here, just for some perspective, I estimated if you were holding a moderate portfolio, so that would be a modern portfolio asset allocation of about 60% stocks, 40% bonds. We've covered that before, right?
Yeah.
If I estimated that right around minus 16.41%. So I just wanted to give that perspective to people who maybe are doing a buy and hold approach this year and what might have happened.
Right. So that's important to remember, that because bonds have been down so much and the stock market's down, don't think that your balanced portfolio is behaving the way that you thought it was when you originally purchased that. If you're a client of ours and you're in our actively managed portfolios, you're not experiencing the same thing, because we look at things in a different way. So it's not a buy and hold approach, it's active risk management. It's what we do. Of course, if you are a client, we want to visit with you about how you did last year. And we can, of course, talk about that if we haven't talked in the last few weeks or so.
Right. Another really common thing in this industry is a target date fund. If you have a 401k, you've never looked at it, and you don't know what's going on with it, odds are probably pretty high that you're in a target date fund, right?
Yeah.
So these are built out for the day that you retire. And I just had an example here, no specific fund, but the one that I looked at was minus 19.1%. This would be a 2040 end date for that target.
Okay.
And you know, this would be a worker maybe in their 40s.
So a lot of folks that are participating in their workplace 401k plan are going to maybe default into a target date fund. And target date funds, a lot of people think that the 401k plan provider is actually managing their money, and they're not.
Right.
Target date funds are not exempt from drawdowns in performance and stuff. So, good example there, Jesse.
Yeah. So a huge thing that happened in the past couple of weeks is the Secure Act 2.0. So we're going to talk about that for the rest of the webinar today.
Yeah, and so let's go ahead and jump into that. This was part of the omnibus financing bill for the government. You may have read a number of different articles. We're still unpacking this because the bill only had about 4,500 pages of detail, and a lot of it was pork and waste and things, but there was a number of significant changes that got signed into law regarding your retirement accounts and things. So we're going to be sending out letters to all our clients. If you'd like to get on our mail list so that you can get updates on these things, you might want to Send us an email at info@clearvistafinancial.com. That's info, I-M-F-O, at clearvistafinancial.com, and we can get on our mailing list. If you're already a client, you're going to receive that anyway. So in that, and I'm taking here from a Wall Street Journal thing, we're going to need to rethink how we save for retirement after Congress passed a series of laws that stand to overhaul significant parts of our country's retirement savings system.
Mm-hmm.
Now, this was passed just before the holidays. It includes dozens of retirement policy changes that go into effect over the next decade. Some of them are effective now. Some of them will get grandfathered in and go into effect as late as 2027. So a lot of them already kicked in. We're going to examine some of them, but you need to talk to your financial advisor about how these may impact you, especially if you're working.
Right.
And the main changes that go into effect right away include some incentives for more employers to offer retirement plans and to encourage workers to contribute.
Right, and that's a good thing.
Yeah, we're going to cover a couple of those today. Let's jump in right here. Okay, so the big change is required minimum distributions. Okay, now in the Secure Act 1.0, we had basically they moved the required minimum distribution age. This is for your retirement accounts and IRA accounts and such. That year was 72. And so when you turn 72, the year that you turned 72, you were required to take out distributions from your IRA accounts and retirement accounts. So the good news is they're moving that back to eventually be the age of 75. Now, if you're already taking your RMDs because you're 72, you're going to have to continue to do that. But for example, if you happen to turn 72 in 2023, you don't have to take an RMD. Your first required minimum distribution will have to come out in 2024.
So this essentially is for people who are not taking RMDs yet.
That's basically the way to look at it. If you're not already taking an RMD, your start date is going to get pushed back. And eventually, for those folks that were born after 1959, your RMD age will be 75. So congratulations, Jesse. You don't have to take an RMD until you're 75. So, and also they also changed the RMD penalty. Now, before all this was done, the RMD penalty, if you forgot to take out your RMD, was 50% of what you were supposed to withdraw. That's huge penalty. Now, a lot of times we could get that corrected for you, but they've lowered that to 25% because they want you to come forward and correct it. If you do it in a timely manner, then the penalty is only 10% of what you were supposed to take out. Now, as far as early withdrawal penalties, they added exceptions to waive the 10% penalty for firefighters, public safety workers, and folks that have a terminal illness. Okay, so that's a change. And they're going to start requiring plans to provide with emergency withdrawal of $1,000 for those affected by disasters, victims of domestic abuse, and potentially to be used for long-term care premium payments. Now, this is something we're giving you stuff that's hot off the press. We always have to wait a little bit for the IRS to give their interpretation of some of these rules before we say these are the rules.
Right.
And so just know these are things that we're tracking out there for you with that. Okay, so some new rules to encourage savings. Small employer plan startups get a credit for starting one, a solo 401k plan. You kind of already were doing this, but plans can be set up during the current 2022 tax season and you still fund it. There's also a $2,500 emergency savings incentive that you can do through your 401k plan. Now, don't call, if you're still working, don't call your HR department tomorrow to find out how to do the $2,500 emergency savings.
They're not going to know how to do it.
They're not going to know yet, okay? And some of these things are going to take a while for 401k plans to be able to figure out how to do. And so that's one thing that we're going to have to wait for things to work out there.
It could be a very valuable feature, though, for those making under $150,000 and participating in a 401k. So that's millions of Americans probably that can benefit from this.
Now, the one thing that I'm really excited about is the Roth employer match. Now, if you're in a 401k plan right now and you're getting matching funds for contributions that you put into the plan, those matching dollars are going into the traditional 401k bucket, or the traditional type treatment. So it's not been taxed, and you don't pay tax on it until you actually withdraw it. Well, now they're going to allow employers to make those matching contributions to a Roth bucket, and that's going to be great. Now, you may think, oh, this is wonderful, thank you, Congress, but they're doing it to generate revenue, because that's money that you would have to pay tax on right then and sooner. And so it's not as great as it sounds, but it is great that a lot of folks can now get their matches put into the Roth bucket, which we think that might be right for a number of people. So that's something. And then there's also some lifetime income provisions as well. We won't get into this too heavily today. The details are still coming out. You all know, if you are a client of ours, we talk to you every year if you're going to take an RMD. We talk about the IRA rollover, charitable rollovers and things like that. But really, the qualified charitable deductions from IRAs, we want to do that. These are getting into annuities and things. We're not going to talk about them in great detail, but if that's something of interest to you, we will certainly visit with you about it as more rules come out. So what does all this mean? Well, you need to be paying attention to your statements and educating yourselves. This is one of the big New Year's resolutions that I'm encouraging folks to take on, and that is, educate yourself about what's going on in your portfolio. Our philosophy hasn't changed at all, and this is a time where we encourage you to look at your statements. If you're in a 401k plan, don't just stick it in the junk drawer. Open it up. You need to see what's going on with that 401k plan. We can help you with those things if you are not satisfied with what's going on with that. Unfortunately, a lot of plan providers for 401k plans don't give you the actual performance, and so you may not think that's a big number, but it could be a huge number performance-wise. So you want to talk to a professional. If you don't have someone to talk to you, you can give us a call. You can visit us at our website. Let me give you the short version of it. It's just spendlifewell.com. That's spendlifewell.com. And we don't know what 2023 is how it's going to unfold, but we do think that there's still going to be a lot of changes and a lot of things that are going on. If you've got questions, you can put them in the question box if you want to. But I think with the things like the changes in the Secure Act, the Federal Reserve is still going to raise interest rates this year. I'm not seeing anything that leads me to believe that they're going to start cutting rates. That will be an indication that the stock market should turn around when they start cutting rates. I would not jump the gun there until we actually see that. Our philosophy is we respond to the data that we're given. We're not trying to be in the prediction business. No one can predict the future of what any investment will or will not do. And so now's the time to be taking advantage of opportunities to invest while prices are cheap. And if you're still holding on to that buy and hold portfolio, that old 60-40 portfolio, I think this year, if anything, has shown us, Jesse, that that's not going to work in the long haul. But if you're working with us already, you know how we do things. If you're not, we'd love to visit with you and get to know you a little bit better and show you how we might be able to potentially help you with your portfolio, maybe protect it a little better, or position it for the rebound when the market does come back for us, hopefully. So the easiest way to do that is just to schedule a call. You can get on my calendar and schedule a consultation. Just go to calendly.com. That's /Mark Trice. That's www.calendly.com/Mark Trice. And of course, give us a call if you want to. You can do that, and we'd be happy to set up a complimentary consultation for those things. I know we've given you a lot of information and data. I don't want this to be the end of our conversation. We've changed the time that we're doing our ClearVista financial perspectives. We want to do those during the week. I know Saturday was a problem for a lot of folks to be able to join us Saturday morning. So we'll be doing this on the first Thursday of every month. And we hope you join us the next one. We'll send out a reminder later on, but you can always go to our website at clearvistafinancial.com, click on events, and register for the next ClearVista Financial Perspectives, okay? And I don't see any questions, Jesse. So with that, we're going to go ahead and wrap up for today. Thank you for joining us. Have a great rest of your week and Happy New Year.